Good morning, everybody, and welcome back to our technology conference today. So it's my pleasure to introduce what I think is going to be an interesting panel, something that certainly I think you're going to find very interesting, given that we've assembled what I would say are two leading hybrid ITSP companies today. So joining us on from that front is Sean Main, the CEO of Converge Technologies. And also we've got Andrew Caprara, he's the COO of SoftChoice. And also joining the panel from the system integrator side is Russell Smith. He's the president of Alithya US. So welcome, gentlemen. And just before we start the actual conversation, I just want to remind everybody that make sure your microphone is on mute. And I'm speaking to the attendees, that is, make sure your microphone's on mute. Make sure your camera is turned off during this session. And please ensure that your name appears on the screen so we can properly address any questions you may have. And should you have a question, please use the hand feature, or you may submit your question by using the chat, and we'll make sure to get to that question as soon as we can. And just so you know, questions will be moderated by Jordan Simon. We'll also be handling any technical issues that hopefully do not arise during the session. So with that, we'll get started. So again, gentlemen, welcome.
Thank you.
So just a couple of questions that I want to have for the overall group, and we'll go in company order, if you will, through some of these questions. So the question is, can you guys take a minute or two? And when you look around at the panel members, again, given the diversity of some of the guys that are in this panel, can you highlight for the attendees just a little bit about your company, but more importantly, how your strategy is different from the other guys that are participating here in this panel? So with that question, we'll start with Russell from Alithya.
Thanks, Nick. If you look at Alithya, there's really three core elements to our strategy, and that's centered around our clients, our people, and our investors. Now, from a client perspective, obviously we are looking to grow both organically as well as through acquisitive growth, but really trying to provide those high value services. And as a systems integrator, we tend to shift oftentimes more towards the SaaS end of the market, where there's a high growth rate in that space, really looking at enterprise applications. So less dependent on the hardware, if you will, also less dependent on, we do provide cloud infrastructure, data analytics, we provide all of those key areas, but really we are keen in terms of business application services, business strategy, enterprise applications through cloud related services, and also the data and analytics. And so as being in that role, it's very important for us as a systems integrator to build that trusted advisor relationship with our clients. Relative to our people aspect, we want to be known in the market as best of breed for employee engagement, because we're constantly trying to grow and feed our organic growth engine by bringing on new talent. And as part of that, even though we do have acquisitions as part of our foothold, I joined Alithya myself through an acquisition in 2018. Paul Ramon, our CEO, one of the first things he delivered to our team in a message, he actually used, if you go back to the movie Miracle on Ice, there's a scene in there where he talks about, hey, we play for the name on the front of the jersey. And even though we bring in our own expertise and areas of strengths, we all play for the same team. We're one team, part of Alithya. And so just building that collaboration throughout the company, investing in our team for growth and leadership, growth and career path, and well-being, that's so important to us. And then lastly, Nick, from a client perspective, we are clearly focused on, as I mentioned before, organic growth as well as acquisition. But through that implies revenue growth, but also profitable revenue growth. Very important to us. And in terms of growing that base, we look to our existing clients. Through the acquisitions, it's very important that we're able to offer our customers more high value services through the combination of the capabilities we have at Alithya. And so if you look at that customer intimate model, where you may start with an enterprise application, but then you may come in with more of a hybrid based IT solution where you're helping to modernize their some of their on-premise applications, moving them to the cloud. All of those areas are important for us. And as a side effect of that, we invest in innovation. How can we do things easier, more efficient? How can we make that disruptive in the market and give us a competitive advantage from a differentiation perspective?
Okay, thank you for that. I'll turn the mic over to Sean.
Thank you, Nick. And thanks for giving us the opportunity to talk today. So Converge is really focused on helping mid-market companies get to the cloud. We have a growth through acquisition story to acquire customers and then turn them into acquire these companies and turn them into cloud and managed service providers. Our mid-market US is our most dominant marketplace. We're also present in both Europe and in Canada. And really, when you look at who we are, on top of these kind of VAR we buy, we have these practice areas around analytics. I have an 85 data scientists in my analytics practice, 100 security architects in our security practice, these cloud practices that put people inside of Kubernetes containers, and then our managed services. So the capabilities that we've built on top of this by buying companies like Carpe Data and LPA, and last week CBI, around analytics and cybersecurity, from a capabilities perspective in the market in the US tend to be quite unique. And then really what differentiates our model is our growth. No one grows like Converge. Last year we grew, our organic growth was 9.6% with the supply chain issues. This year we're guiding 20% organically, 50% inorganically. So I'm going to grow my revenues by 70%. And that's because I believe we've got a better model. Rather than hiring salespeople or training up salespeople, buy companies and deconstructing them for their salespeople, sales management, engineering management. But as was just mentioned, profitable growth. We've grew our earnings the first 3 years by 90% every single year. Last year, we grew our earnings by 55%. This year, we'll go back to consensus is 90% earnings growth, 70% revenue growth, 90% earnings growth, no new shares. We are very, very well capitalized. And so to have that kind of revenue and earnings growth, I think that really, especially when you've got a multiple less than 10 times forward and you generate free cash flow. Last year on our 94 million of adjusted EBITDA, we had 87 million of free cash flow. This year on 175 will be over 140 million of free cash flow. On a go-forward basis, that also pays for our $1 billion a year of acquisition revenue. So a very aggressive growth company, really focused in on the higher value services and managed services and helping people get to the cloud. So that's kind of our growth model is really what differentiates us.
Okay, and then Andrew, if you want to.
Sure.
Go ahead.
Yeah, thanks, Nick, and thanks for having me. At SoftChoice, we think we're pretty unique in the broader IT ecosystem, particularly in North America, among those large-scale solution providers. And there's 3 real reasons for that. The first is that we do have a differentiated go-to-market strategy that really focuses on the high-growth subsectors in that IT world. So we focus on enabling those hybrid multi-cloud solutions that really are at the center of the customer's transformations these days. And we've got the highest level certifications with the major hyperscalers. We've got the top level certifications in Azure and Google Cloud, and working on AWS as well as many of the critical enabling technologies from partners like VMware, Red Hat, and others. We also enable collaboration in digital workplaces, which are increasingly important, obviously, over the last few years, so that our customers' employees can collaborate securely from anywhere in the world on any device at any time. And finally, we've got a 30-year history in software. And so we wrap all of our solutions around a really rigorous and highly orchestrated software asset management approach that helps ensure that our customers actually maximize the investment that they made and keeps them in compliance on these complex agreements. And then obviously in this world, you've got to wrap all of that in security, as cybersecurity is at the top of mind for every company across the world. The second area that we differentiate is that, as I said, 70% of our business is software, cloud, and the associated services. And so that's really different than the broader landscape in North America. And it's great from a financial perspective for recurring revenue and repeatability. But really what differentiates us for customers is that it really dictates how we structure our sales team and our go-to-market approach, because we're focused on the customer success motions that allow customers to get the most value out of the types of purchases that you need in software and cloud, and not focused on the one and done kind of project or capital sales models that's kind of pervasive in the industry. And finally, the last area is that we do have just an end-to-end ability to take responsibility for all of the customer's environment. So we can help with the initial purchase selection like a traditional VAR could. We could do all the implementation services in these areas like a system integrator. And then we've got those advanced managed service capabilities to help manage, govern, and operate that environment like an MSP. And so all of that allowed us to organically drive 20% gross profit growth last year, and also allowed us to drive really high free cash flow at 90% range. So all of that really creates that significant operating leverage to drive that margin expansion over time and allow us to fund this organic growth that we're on.
Okay, great. Thank you for that. So the next question again to the entire group. Obviously, there is a chip shortage that's impacting hardware deliveries, but nevertheless, when we look at the latest Gartner report that's out there covering the entire IT spending landscape, when we look at the numbers for 2021, they're calling for greater growth, I think 9.5% versus the previous forecast of 8.6%. And then we look at in the same report, it looks like for 2022, IT spending is at a 5.5% rate versus the prior 5.3%. So a little bit of an acceleration in the marketplace, again, despite the chip shortage overhang. So maybe if you guys can talk to the markets that you guys are touching, do you guys agree with the acceleration despite the chip shortages? And if so, where are you guys seeing the acceleration on the demand side? Cloud computing, is it on the devices side, managed services, cybersecurity? So maybe, and how's that acceleration factoring into your organic growth for this year? Is it going to push it higher than maybe what you originally anticipated? So any color commentary that'd be great on that front as well. And we'll start the question with Russell from Alithya.
Thanks, Nick. Yeah, if you look at our market and again where we play really well, we are seeing significant growth in the market. So if you look at chip shortage and the impact there, we don't have any hardware elements of our business that come into play. But from an overall growth perspective, as I mentioned earlier, we play in that SaaS space really well. And so if you look at ERP, CRM, EPM, some of the different solutions, Gartner is projecting that some of those businesses in 2022 will grow 18% year on year. And so we've certainly seen that translate across all of Alithya into our growth this past year. If you look at our Q3 earnings, we're up 35% organic growth. That's really strong. I believe that's industry leading in the market. We also had 50% overall growth in terms, including our acquisitions that we made. And so again, we're well positioned for growth, and we're seeing that in the market space that we play. A couple of things that come into that, if you look at it, just for example, even though you mentioned the chip shortage, what that's really driven by is supply chain disruptions. And that creates that opportunity, since we're implementing enterprise solutions for our customers, that supply chain disruption is increasing the need for ERP solutions and resilient supply chain. And we are partnered with two of the industry leading partners with Microsoft and Oracle. And so again, we're very bullish on the opportunities to continue to grow in that space. Other areas we see real growth, if you look at healthcare, for example. And again, I just mentioned that we were partnered with Oracle. Oracle just made a $23 billion acquisition of Cerner, again, trying to strengthen that position in the space. And so we're very proud of our team and what we've accomplished this year, growing 35% organic over this last quarter and strong organic growth posted throughout the year, growth in our bookings. I think that bodes well in terms of how we're continuing to build and grow the business organically, as well as those strategic acquisitions that play well in that space. Okay, thank you. Sean, if you want to weigh in.
Sir, super. One thing I did want to mention, just so we're using the same definitions, when SoftChoice uses 70% of their business comes from software and services, they're talking about gross profit and not revenue. We have the same amount of hardware as a percent of net revenue that SoftChoice does. So I just want to make sure we're like for like. The demand environment we're seeing there in Q1 is been something I've never seen before in a Q1. So the demand environment is incredibly high. As we've talked about before, the supply chain issues were mostly around the network side. Certain vendors were never impacted, kind of like the IBMs and NetApps. You saw Apple and Dells of the world get better. But as we move more to software-defined networking, and as you move workloads to the cloud, it's really the networking component. That's probably why you see Cisco and Arista and Palo Alto having problems. That's really where the bottleneck has come. But despite that, we grew 9.6%. We're guiding this year, we're growing at 20% organically. And the demand you're seeing, again, in Q1 has been much higher than historical areas, particularly around some areas like education and healthcare, where the service model changed because of work from anywhere. In Germany, I think we've mentioned our RedNet acquisition, which provides a teacher help desk to help teachers not just use IT, but deliver curriculum online. We gave teachers, as well as doctors and nurses, Zoom and Teams and WebEx, and expected them to be able to deliver online services, and they can't. And the services around that, the managed services around end user, the cloud-based deployments. We're doing the same thing in North America around healthcare. Nurses helping doctors and nurses deliver online care in a HIPAA compliant way. So I think what you're seeing is people were unprepared from work from anywhere. It changed the trust model to zero trust, where before you were trusted users. And so as you're moving these workloads to the cloud, there's these new service opportunities available to people in our spot to provide a lot more managed services around verticals in the past that weren't as open to it. And that's because of the work from anywhere.
Okay. And then Andrew?
Yeah, I agree with the guys that we are seeing absolutely above average growth. As we mentioned, we had 20% last year. 25% was our growth in software, cloud, and service solutions, and a lot of that's driven by digital workplaces, the pandemic driving the remote work world, security software to make sure that they can actually do that all securely from anywhere, and obviously the hybrid cloud and infrastructure driven by increased public cloud adoption. It's because there were two sort of trends that we started to see over the pandemic. One was obviously many organizations couldn't get to their data center, right? So they were already starting to think about how they can leverage cloud-based applications or migrating to the cloud as a means of business continuity and operations through the pandemic. Then you got to the point where they came back and some of them had to modernize a data center and they're stuck with a supply chain constraint. They might not get their servers or their network gear for 6 months, 9 months or longer. And so that's driving this move to use the public cloud more and more. The addition to that on top, though, is because of the pandemic, obviously business models changed. The way that customers are using applications to serve their employees has changed. And the number of applications in any environment has grown exponentially. I recently saw an IDC analysis that said the number of applications in use from 2019 to today is up 4 times, right? 4 times increase in 3 years. And they're saying over the next 5 years, there's going to be more applications created than in the last 50 years. And so all of those applications then in a customer's environment create such a tremendous opportunity for service providers, because now they're in a place where they've got to figure out, well, where am I going to host these? How am I going to develop these? Do I even have the skills to modernize the ones that I had before to operate in this new world? And how do I start thinking about the security, as Sean said, in that zero trust environment of having these things everywhere? And then beyond that, you now have more and more people who are interacting with all of these applications from different places and different devices, because they're no longer sitting in your office as they were before. And so it just creates this amazing opportunity for us in this kind of digital first environment to help customers with the services to actually deploy, migrate, and modernize applications, and then start to develop some of these new applications that can transform their businesses and ultimately change the way they operate and change the way they work going forward. And sometimes these applications actually create a bit of downward momentum on the cost side as well, right? I think it was Satya Nadella who said technology is the deflationary force in an inflationary environment, because as you drive efficiency and through the operations and through automation, it actually allows them to do more with their existing workforce and save in a really tough labor market. So all of these trends, Nick, are far outweighing any concerns that anybody, I think, has around the supply chain constraint.
No, very, very, very good comments. Appreciate that. So next question, and it's gonna just focus on the chip shortage and the impacts that we're seeing in supply chain. So it's geared towards Sean and Andrew. just given the fluid environment that we're in, and maybe just give an update on where the chip shortage sits as far as how it impacts your businesses. It looks like it's getting pushed out further and further. So I'm just wondering with which hardware providers are you guys best positioned first and foremost, and the ones where you're maybe some color as to the other hardware providers, maybe if you're seeing that supply chains with those other guys is being pushed out. So this is not going to be a first half reversal. It might be a second half reversal, or maybe highlight guys where you think it might be a 2023 reversal, and just talk about how that push out might be impacting your organic growth either for this year or for next year. So really, is the needle moving when it comes to the reversal on the chip shortage side, and how is that impacting your business? So that's the crux of the question, and I think we'll go in reverse order here. So we'll start that question with Andrew from SoftChoice.
Yeah, sure. You know, and Nick, as a reminder, we're, as I said, 70% software, cloud, and services, and so I think we're probably less impacted than some of the others in the industry and some of our peers who've got a heavier weighting there. And for us, that was about a $7 million impact, negative impact on gross profit last year. So meaning we had $7 million more of excess backlog in 2021 than we would normally have. And for context, that we generated 287 million in gross profit in 2021. So, you know, it's a couple of points probably of growth in the year that would have impacted us. So not something that was materially inhibiting our growth last year, nor do we expect it to be a material change for us in 2022. And at this point, we haven't seen it really worsening, and we haven't really seen it getting better yet. So I think we're still expecting the pressures to continue on later this year, and perhaps even into 2023. And then I think it'll revert back to normal levels, and at some point we'll get that sort of modest gross profit tailwind whenever that does happen. But it hasn't been a specific focus for us because it hasn't been a hugely important, impactful part of our total number.
Okay, and Sean, your take?
Okay, so there's been a lot of misinformation in the space, and when SoftChoice says 70% of their revenue, or sorry, of their business comes from software and services, that's gross profit. When I look at their financials, when I compare their net revenue to their hardware, it's like 55%, which is not so different from us. So I don't see how you're not impacted just like everybody else. As we said, this supply chain issue is all around which vendors. What happened was in Q3 of last year, it was the manufacturing plants that were operating under 60% capacity for certain vendors. IBM was never impacted. They're our largest vendor. About a third of our business comes through it. That includes software, of course. Then, NetApp wasn't impacted. The people that have good supply chains that were surprisingly impacted were Dell and Apple. So they traditionally, because they had better supply chains than, say, the HPEs and the Ciscos, they tended to do better. They got worse. And then Q4 demand was so high that they still remain poor. Over Christmas time, we saw Apple getting better. We've seen Dell getting better. Now, there's been some announcements around Foxconn, which actually isn't impacting iPads. It's more iPhones, which is actually probably if they're decreasing capacity, it'll help the iPads. But that business around education and healthcare is important. When students get those, we do managed services around that. So our ability to have devices to do managed services in healthcare and education, we monitor that. On the network side, it is a problem. So if you wanted a router today, you're looking at 6 months time frames from Arista and Palo Alto and Cisco. So what that hurts is as you move workloads to the cloud, you've got obviously the network piece. We try to make as much software-defined networking where possible. We might use refurb gear to replace when it comes in, but because cloud growth is really intensive on network, the network component is the key area to focus on as it gets better. So I see the other areas getting better. I see the networking piece is still a concern. And again, in the backdrop of this incredible demand, just like SoftChoice, 70% of my gross profit comes from non-hardware related. So you're still going to see some great numbers, but my backlog went from 250 million at the end of Q3 to 350 million at the end of Q4, and it's only grown. So you're seeing this incredible backlog. What that means is when finally the supply chain does get normalized, you're going to see some massive quarters. We've become a very, very large company. We'll be bigger than Softcat this year. We'll be bigger than CanCon next year on our journey to above 5 billion in sales. So we are growing very, very quickly. And this means that during this year with our, as we've stated, $1 billion of acquisition revenue, which we've already done 400 million, we're going to have 20% organic growth. You could see upside on top of that if the supply chain normalizes.
Okay, and maybe just for apples to apples comparison, obviously, Soft Choice has said it was a $7 million impact on their gross profit. Can you maybe give us a similar number on a gross profit basis when it comes to shortage?
When you buy 30 companies over 5 years, it makes harder to do gross profit, especially how you allocate rebates. So rebates we get in bulk from our vendors, from our distributors and our vendors, and that lumps together hardware and software. And that's why we lump them together as product. So distinguishing on a gross profit side, how much that means between hardware and software is more difficult for us to do. But yeah, definitely it's a bigger impact than what they are, but we're a bigger company as well.
Okay, we'll move on to the next question. So I'll ask the question, and then at the end, so the initial question will be geared towards Converge and Soft Choice, but then I'm going to want Alithia to weigh in on the response side. So the question is, we've seen both Soft Choice and Converge move further downstream towards higher margin businesses. So if we think about Soft Choice, obviously, you heard him say earlier, they've got some system integration capabilities. Obviously, software is a big driver for their business overall. In the case of Converge, we've seen them make an acquisition just last week, or maybe it was even early this week. I losing the track of time there, but anyway, acquiring, I believe it's called InterDynamics, which moves you more into the system integration space. So the question for the both of you is, when you look at where you're sitting today in the whole hybrid ITSP space, and which is at the higher end of the whole margin curve relative to the VARs and the resellers, and then you've got the system integrators sitting, let's say, to your right. Are you guys looking at moving your businesses further and further to the right? In other words, adding more software, adding more services, and quite possibly adding more system integration capabilities to your businesses? So that's the question, and then Russell will have you weigh in on that.
Sure.
And sorry, and we'll start with we'll start with Soft Choice. So Andrew.
Sure. We've been on that transformation, Nick, and obviously our focus is expanding that ability to be that trusted advisor to the customers, and which ultimately last year has led to records gross margin per customer and improved logo retention of customers. So both of those combined to help us achieve 113% revenue retention in 2021. So as we go deeper and deeper, that number continues to grow. And a decade ago, if any of you knew us last go around as a public company, about half our gross profit came from customers who made product-only purchases from Soft Choice, which obviously is a much more competitive and lower margin product business. But today, less than a third of our gross profit comes from customers like that. And more than 2/3 are from deeper IT solutions and bundles of products and services for our customers. So obviously, are a lot stickier, they're higher margin per customer and higher retention. And our logo retention in that group is actually 98%. So really, really high. And we did that in 2017 because we reassessed our strategy in light of what we were seeing in the market. We saw accelerating growth and adoption of the cloud and a shift away from on-premise infrastructure. We saw increasing demand for collaboration technology then, which was only accelerated by the pandemic. We saw customers looking to integrate more and more software applications into their environment because these solutions became much more interconnected. And then obviously the continued escalation of cybersecurity threats that we were seeing. So at that point, we refocused our business around those fast subsectors that I mentioned earlier, the hybrid multi-cloud, digital workplace and collaboration, and software asset management, and all obviously wrapped in security. And we focused on a few major initiatives to support the execution of the strategy and start to move right, as you said. First, we redesigned our commercial model to really target these strategic customer segments. And we built that deep and multi-layered bench of technical experts and solution architects and specialty sellers to really increase the value of the conversations and increase the value that we brought to customers through that software and cloud first approach. The second thing is we made major investments in our hybrid multi-cloud strategy. And that allowed us to go much deeper into Microsoft Azure and much wider into AWS and Google Cloud. The third thing we did was we aligned our professional managed service offerings around these three strategic focus areas and really built out what we could do in those areas. And fourth, we implemented a project called Project Monarch, which was our own internal IT business transformation to enable us the tools to scale this business really rapidly. And then over that time, we continued to deepen our key partner relationships and even added new ones like Google, who's come on since 2017. So I think we're actually better positioned now than ever to capitalize on all of the market trends that that me and the guys have been talking about on this call. And you know, earlier this week, actually, we were honored to be named VMware's top partner globally from the capabilities and the impact that we're having with VMware. And as I mentioned, we already hold the highest level service provider designations from both Microsoft Azure and Google Cloud, and AWS being in progress following the announcement of our multi-year strategic collaboration agreement. And so this really uniquely positions us in the market to be that truly agnostic solution provider with the deep technical capabilities that help customers succeed across all environments in this multi-cloud world. And to your point, Nick, we're not done, right? We're continuing to invest in these capabilities to meet the demands of customers. You know, last year we increased our public cloud certifications by 66%. We added 70 more technical experts to our team, which takes our total now to 720 technical experts to go along with our 630 sales team members. And we'll obviously continue to invest to build internally or potentially even look to acquire some of the advanced capabilities that are only going to strengthen our market position in this area to go deeper into areas like application development, DevOps, AI, machine learning, data analytics, and those kinds of areas.
Okay. So I will say, I guess as one of the few analysts that covered the company SoftChoice, that is, on your first go around as a public company back in, I want to say 2013, 2014. Yeah. I recall back then, I think you guys are more Microsoft centric, and I could certainly see the transformation while you guys were private and coming back to the market and really introducing more and more of those services and the influence it's had on your business. So I certainly agree with what you just highlighted. So Russell, question for you from the Alithya front. Given what you've heard from both Sean and Andrew and how the hybrid ITSP companies are pushing more and more, looking at more and more features or capabilities, what have you, to expand their margins, and in some cases moving more and more into the SI space, I'm wondering, first of all, are you guys seeing any consolidation or collaborations between the hybrid individuals and the SIs in the marketplace? And then the second question is there any consideration from Alithya's side of things to maybe move a little bit to the left and maybe acquire some of the expertise that these guys are doing? It might be getting more into the software market specifically.
Yeah, so Nick, let me give you a little bit of a perspective, and I'll use the US as an example. We do have some software element in our US business with Microsoft. And as part of that, that is SaaS-based, though. Again, Microsoft is one of the leading players in that enterprise space for SaaS-based products and services. And so as a SI, we believe we're well positioned in that market. We've seen, again, across all of Alithya, year to date through the first 9 months, our gross margins are up over 40%. And so we clients is when they went through that process, again, our customers had to rethink the way that they were going to engage with their employees, with their suppliers, with their customers. And so that's really driven a large demand for enterprise and SaaS-based cloud applications. Now, as part of that, we already touch hybrid IT platforms today, because as we go in to implement a SaaS-based, cloud-based application, if you will, our clients have legacy applications we're using DevOps, we're modernizing that technology platform for them today, as well as what they might have on premise, if you will. So we are seeing consolidation in the space from an SI perspective. I'm not as well equipped to speak to the integration or consolidation between your more typical SIs and the hybrid IT platforms, but I will tell you from an Alithya perspective, we're very focused and targeted on the types of acquisitions that we're making. It has to be high value, high margin. We immediately want it to be accretive, and so we're looking for opportunities, as you will, that blend out those capabilities. One of the acquisitions we just made in February with Vitalist, again, I think tells a good story around the markets that we play. And so if you look at Vitalist, more of a training-based platform, Vitalist plays strongly in the Microsoft space, especially around Teams, email, Microsoft 365, and Microsoft Dynamics. But if you look in this space, especially that SaaS-based space, when you as a CIO make an investment and you're buying software technology to deploy to your team, one of the key things you're looking for is, how is that adopted? How is it consumed? Because you're spending the money to adopt it, but you only get the value and the insights out of it if your team actually uses it. And so we saw an opportunity to bring in Vitalist from a Microsoft perspective. They are recognized as the teams. They won an award the last 3 years for being the Microsoft Teams Player of the Year, if you will, and recognized because what they do is when a customer makes that purchase and they've invested in that technology, Vitalist will come in and they will help deploy learning initiatives, training initiatives, and adoption initiatives to help that investment realize its benefit, because they're trying to help drive consumption and usage of those platforms. And so again, if you come back to just where we're positioned in that SaaS-based market, if you look at our Microsoft team, we just got back from Santa Barbara this past week for Inner Circle, and that's where Microsoft recognizes the top 1% of its partners worldwide. And so we've been in the Inner Circle for, I believe it's 16 or 17 years, one of the leaders in that space. And that's because of our ability to sell and position the software, but also as an SI to be able to deliver the services and solutions surrounding that. And so again, from an Alithya perspective, looking for those opportunities that allow us to get closer to the customer as that trusted advisor with high value solutions, and looking not only at SI, but of course, looking at different types of capabilities, including hybrid IT.
Okay, great. I appreciate that color. The next question, just for Sean specifically, when we look at the geopolitical situation that we're living in right now between Russia and the Ukraine, and obviously the fears of inflation that are out there in the marketplace. And you alluded to this earlier about, well, you talked about Apple as far as no impact on the iPhone and iPad right now, but we are seeing a little bit of a cutback in production when it comes to some of their products on weakening demand. Just what are your thoughts? We can use Apple as the example, but do you think that using Apple as that bellwether, do you think that maybe we're starting to see a little bit of industry-wide phenomena where demand might actually be weakening in the marketplace, and again, Apple is that early stage indicator? And if so, if that were the case, how do you see maybe the risk when it comes to your top line growth for this year and for next year?
So I was thrilled to hear that they were reducing capacity around iPhones, because it means they can make more iPads and catch up on the supply chain. So it's a consumer. No, I'm dead serious, right? So where does capacity grow? I guess it's going to go to iPads. So for me, that's a consumer related issue, which I think is absolutely valid, and they are a bellwether for the consumer related. As far as unwinding the supply chain, that capacity gets to move over to other products, and I would be thrilled if other people had, because that helps my supply chain out. So for me, that's a wonderful trend. Again, demand with businesses moving workloads to the cloud. Like everything that the Softchoice guys are saying is right. Like we lead with Red Hat and VMware. It's the high-end services. It's around the cloud providers. It's hybrid IT. These are all the trends. What we try to add to that, obviously, is on the analytics side, and the security side, a lot more of those depths and managed services, which is where the higher margin stuff is. But these trends, the demand is off the charts. So anything that can help the supply chain in dealing with that, I'm a big fan of. So with Apple in particular, because I was watching Foxconn, because there was another issue where one of the Foxconn plants, who's the contract manufacturer for Apple, shut down. Again, it was iPhone. So I've been paying very close attention to that, because with an education in healthcare, a lot of the students and things have devices, and devices you don't make money on, but you do make a lot of money on managed services around it. And so our managed services revenue will be impacted by delivery of iPads. And so I hope this is a great news for iPads.
It's a good, yeah. So I think what I'm hearing, and just kind of summarize what the three of you guys have been saying so far, is the enterprise side of the market, that demand is super strong. And we might, if the market looks at Apple and as a bellwether, any noise that we might be hearing out of them is more of a consumer impact. It has nothing really to do on the enterprise side. So, as far as you guys are concerned, you're
so
not
far. So far, yes.
So far, fair comment.
Yeah.
So far, there's no worries, no concerns as far as 2022 and possibly 2023, just given the information that is out there today. But anybody that's consumer centric, that's a different story. So then, with regards to Softchoice and Alithya, the question I have for you guys is, obviously organic growth is a strong part of your story today. I think augmenting your growth with M&A is also strong consideration when you see the right opportunities. And thus far, we've talked about product growth, as you guys are seeing it, and by all intents and purposes, very strong. My question to you is, what are your thoughts around geographic expansion? So really moving outside of North America, getting into the European markets and just other international markets. Is it something you guys are looking at in the short term, medium term, long term, or really don't have any consideration whatsoever? So with that question, we'll start with Andrew.
Yeah, obviously, Nick, it's something that we have to review as a management team, but at this point, it's not going to be part of our growth strategy. We just think the opportunity for us in North America, and particularly with what's going on and all the trends that we talked about, is so attractive, right? It's $1 trillion market, and we estimate our addressable market within that is still about $300 billion. And so, we are one of the larger players in North America, particularly focused on software and cloud. But even saying that, we've got about $2 billion in gross sales. So we're talking less than 1% market share. And you could go all the way up to the largest in North America, and you're still talking probably high single-digit market share. It's extremely fragmented, right? So there's so much opportunity for us in this market that we're going to remain focused on taking advantage of that right here in North America and increasing our share here.
Okay. And Russell, your thoughts?
Yeah, I very much align with what Andrew just shared. We are focused on growing our North American operations, and we don't have from an overall international growth and expansion. Obviously, that is something that we would look at, but we believe there is so much upside growth in North America right now. Now, one of the things that we are open to is certainly if we see an acquisition, maybe it's North American based, but they have operations or a footprint in some international geography or offshore type capabilities, that is appealing to us. But we're leading first, Nick, with looking at the opportunities within North America, because we see the addressable market, we see the opportunity for growth, and we see the growth we're experiencing today, and we want to continue that trend.
Okay. I guess a few more questions. I think we've got another 15 minutes or so for this panel discussion. Coming back to, I guess we'll continue with Alithya here on this question. Can you just remind us, when it comes to wage inflation, labor scarcity, worker retention, maybe what has been the impact on your businesses thus far? And the bigger crux of this question is really on the labor scarcity side. your ability to convert R3D from a contracted staff to a permanent staff. That was obviously part of the big thesis for investors when you acquired R3D, and doing that conversion was going to help you guys on the gross margin front. Can you just give us some color as to your ability to be able to do that, especially given, I guess, what are more tighter IT labor markets right now?
So,
And maybe if things have been pushed out as a result.
So Nick, I'll address that in two different points. I'll start with just the market overall. And I think all of us, whether it be Andrew or Sean, are experiencing the same thing, because it's a industry-wide challenge in terms of labor, increasing wage inflation, if you will. And so that's certainly been a challenge that we've dealt with this year, and we anticipate that we will continue to deal with it. You've all heard of the Great Resignation, but one of the things that we have been able to do, very proud of our company, is we have been able to find, onboard, equip talent, and deploy them into the market. And so again, through the organic growth that we've talked about, 35% this last quarter, that just goes to show again that we have been able to find and attract the talent, if you will, and engage them to be able to deliver our services. And so that's something that we will continue. We have different leadership training academies. We have academies for bringing in young professionals, as well as college hires, if you will. So trying to bring them in and equip them, train them, mentor them, and again, deploy them in situations where they can be successful and also can be successful for our clients. So investing in that training and that onboarding capability within our organization is really key. Now, if you go more specifically to R3D, we're on track, we're on plan to where we expected to be. That was a fantastic acquisition that we made, and obviously the backlog that came along with that acquisition. And so we like where we are. We're progressing in terms of our plan, and in terms of converting the resources and finding that full-time or permanent, if you will, capability. So we're on track with where we are. Obviously, this is not something that was just R3D, but for Alithya overall, we have experience, because that was a stated initiative we had earlier, that we were looking to shift our model to be more permanent employee status versus contractor status. And we've shared that we're, for every 7 out of 10 employees, we're looking to drive that toward more of that permanent employee relationship. So Nick, again, a lot of work has gone into putting us in the position where we are. We like where we are, and we expect that to continue, but we do not deny that it is a challenging market. And I think we were all seeing that. But at this stage of the game, we can't change the market, but we can influence how we deal with it. And that's what we're really focused on.
Okay, I appreciate that. I guess this would be a question for Andrew, and I think Sean, you kind of discussed this earlier, so I won't ask you this. But Andrew, when it comes to industry EBITDA to free cash flow conversion, it looks like to us it's somewhere in that 70 to 90% range. And when it comes to Soft Choice specifically, you guys are definitely at the top end of that range, and you've been sitting at that top end ever since you've gone public again. So my question is, are you guys comfortable that you can continue to have a strong EBITDA to free cash flow conversion? That's question one. And then question two is, how are you guys viewing the capital allocation that comes with that strong free cash flow generation? Obviously, I think you're the only one of the three guys here today that pays a dividend, and I'm just wondering, does that strong free cash flow generation mean either you're going to be more active in M&A or investments in some space, whatever that might be, or is there a possibility that you guys will allocate some of that to dividend growth?
Sure, yeah. And coming back to the last conversation, it's a really beautiful industry, isn't it? It's like hundreds of billions of dollars, highly fragmented, growing at above average market rates, and driving free cash flow conversion in the 90% range, right? I don't know how many industries out there that can talk about the things that we could talk about here. So it's an amazing opportunity, I think, for all of us, which is fantastic. And as you mentioned, we do have this asset-light business model. So it creates that really profitable and attractive free cash flow. And our guidance for 2022 is 90% conversion of adjusted EBITDA to adjusted free cash flow. And we've grown that over the years since 2017 because we benefit from significant operating leverage. So as we continue to grow our gross profit, it's driven significant EBITDA margin expansion. You know, in 2017, our EBITDA margin was 20% of gross profit, and in 2022, we're forecasting that to be 30%. And again, we use gross profit as our top line because so much of our business is software that's netted down. So that's a truer sense of our growth. And as we go forward, we don't really require capital to grow our business. So the investments required to drive our growth, like in growing our sales force or growing our technical resources and capabilities, have been and are done within our operating expenses, so funded within EBITDA. And the payback for these investments is typically a year or so, so really attractive. So minimal CapEx requirements in our business, we've got that really high free cash flow conversion. You combine that with the strong balance sheet, the organic growth strategy that we've got, and it allows us to continue making the investments we need to drive that double-digit growth while returning the capital to shareholders in the form of the dividends and potentially buying back shares. And so we did actually increase our quarterly dividend by 29% just last quarter. And you know, combined with the share buyback program that we announced, it reflects the anticipated increase that we've got in our earnings in 2022. And we've got a pretty balanced capital allocation plan that obviously will continue to focus on OpEx investments to drive growth while also allowing us to return capital to shareholders. So we've got that strong financial position still, though, even after doing those things, that allows us to remain flexible and pursue opportunistic M&A opportunities when they do come up. So we will continue to drive our organic growth strategy because we know we can get very strong returns there. But if there's an opportunity to be opportunistic, to acquire some of the advanced capabilities that I mentioned earlier around the application world, the data and AI world, then we will look to do that if it'll strengthen our market position.
Okay, great. Thank you. And I guess my last question, and this is for both Sean and Russell, when we look at over the last, I guess, since August, September of last year, we've certainly seen multiples contract within the tech space. And so given the fact that you guys are a little bit more active on the M&A front relative to a Softchoice, my question is, given that multiple contraction, has that in any way changed your business plans when it comes to M&A? And we'll start with Sean.
Yeah, so we've bought $400 million of acquisition revenue so far this year in 5 acquisitions. We've said we'll be doing $1 billion this year. I don't think it's impacted kind of what our view is. We've always been buying at the low end of the scale. What it has done is lessen the competition. Anyone who's an acquirer that requires either to use equity or to raise equity in order to complete an acquisition, I think this is the wrong market for them. So the fact that we've got, at the end of Q4, $250 million of cash in the bank, a $300 million credit line unfilled and generating so much free cash flow, it means we don't ever have to issue shares again to do our acquisition strategy. We've got plenty of cash on hand where others might not. So for me, I view us to be in a pole spot to complete again, the $1 billion per year of acquisitions for the next 3 years. We're in a great spot to do it without having to issue shares. So it's more from a competition perspective. I see less competition. We'll continue to acquire in the way we have.
Okay, and have you, just on the multiple front, have you seen maybe, obviously you guys transact a lot on the private side, have you seen from other companies that we talked to, it sounded like private company multiples have been late to contract, but they are starting to contract. I know that, you know, given where you guys are participating, have you seen maybe more opportunities come up given that private company multiples are starting to contract?
Well, we did just buy a cybersecurity company for 6.5 times EBITDA up front and 5.1 times EBITDA when they hit their earnout. And this is a company with 8% EBITDA margins who is a very little hardware. This is software and services around security, 109 million of revenue last Friday. So to buy that kind of security company, probably the best acquisition we've done, is amazing to do. So in that environment, yes, IDX at 5 times. They have, you know, an EBITDA margin in the teens. So yes, I would have to say that yes, we have our model. 5 times is kind of what we aim for, but there's companies with way more capabilities than I would have been able to get to the past that I'm able to buy in the same multiple that Converge pays than having to go to the 12 to 15 times or even 5 times the revenue for some of these companies that other people pay.
Okay. And then Russell, just your thoughts in terms of how contracting multiples in the public and in the private space, maybe is that accelerating any sort of M&A plans that you guys might have, or is it bringing more opportunities than you had prior?
Yeah, Nick. So obviously that's going to impact the pipeline, the funnel, if you will, in terms of bringing opportunities in. It doesn't really change our approach. We're still very disciplined in that approach, and we have been consistently. If you look at some of our acquisitions, whether it be Vitalist or some of the others we've made in prior years, we're very disciplined in terms of our multiples that we're willing to pay. So if you look at that, I know Sean said 5x. If we're in that 5 to 7x, that's where we've been, even though the market has been inflated above that. And so we believe now that it will increase the opportunity, the funnel, but our discipline in terms of we're looking for high margin in terms of gross margin as well as EBITDA margin, but we're also looking for obviously the cultural fit, and very important, we're looking for leaders that want to stay with the business. And so as we're looking to engage in our M&A activity, we're looking for leadership teams that want to be part of growing something with Alithya. That again, back to that name on the front of the jersey, so to speak, that one team mindset, being able to grow it. So it doesn't really change our approach, but we are bullish relative to the opportunities that we see flowing into the funnel.
Okay. And then just Andrew, I wasn't going to ask you this question, but just thinking about it, I know that M&A is probably a secondary part of the business model, but just given everything we've highlighted as far as multiples contracting, specifically on the private side now, has that brought new opportunities to you guys that you maybe had not seen maybe 6 months ago? And I know you said about the right opportunities, but does the context of what we're seeing on that private company contraction, does it maybe elevate more M&A opportunities for you guys than what you were maybe contemplating 6 months ago?
I wouldn't say it's significantly changed anything, Nick. I mean, we're not going to sort of be undisciplined in our strategy and run after things because the multiples have come down. So any M&A that we do is driven by our strategy and not just the prices that are out there. But obviously, you know, it would certainly help if we could make these acquisitions at a lower multiple, as the guys have mentioned. There's some numbers out there that have been interesting over the last couple of years in our industry, and so I think what we want to focus on is finding that right strategic fit that focuses on the kinds of services that we want to bring to our customers. And that's really the core of what our strategy is. So if we can get it at a few points lower of a multiple, obviously that's fantastic, but that's not dictating our strategy in any way.
Okay, so business as usual, it sounds like it. Okay, so that's going to bring this panel discussion to an end. Hopefully, all the attendees, hopefully you guys found a conversation to be, I guess, quite informative. I know I did. So this will conclude this particular panel presentation. I want to thank both Russell, Andrew, and Sean for joining us today. I do appreciate all the insight you guys have been offering us over the course of this 1 hour conversation. And as we wrap it up, I'll just remind everybody that our next presentation starts at 11:10, and we will be having a fireside chat with Kinaxis. So thanks, everybody.
Thanks all.
Thanks all.
Thank you.
Thanks, Nick.
Bye-bye.